Capital Budgeting Cash Flows, Chapter 11. This chapter builds off of capital budgeting techniques from Chapter 10. Also has information in it from Time Value of Money, Chapter 5, and Cost of Capital, Chapter 9, and Interest Rates in Chapter 8. So this sort of ties everything together. And what we're really looking at here is in Chapter 10, we talked about some of the basic capital budgeting techniques, and we're going to pull those together, and we're going to incorporate cash flows to see how a company is valued. So we're going to discuss three major cash flow components. Then we're going to talk about cash flows, expansion versus replacement decisions, sunk costs, opportunity costs, international capital budgeting. We're going to calculate initial investments associated with a proposed capital expenditure. We're going to discuss tax implications associated with selling an old asset. We're going to find relevant operating cash inflows associated with proposed capital expenditure, and determine the terminal cash flow associated with a proposed capital expenditure. Doesn't that sound fun? So it really is kind of an interesting look at how to value a company, because that's what these capital budgeting is really about, is valuing an investment to figure out if it's worth doing. So that's the overarching idea of these Chapter 10 and 11 is, if you have an investment, whether it's buying stock or buying a house or buying a company or expanding your business, buying a piece of machinery, a new piece of equipment, these are all investments. And we want to look at what kind of cash inflows are we getting, and what's the incremental cash from these investments to figure out whether or not the investment is worth it. So this is really a managerial process, financial managerial process, to review proposed expenditures to see if it's worth it for the company. So the first part here, relevant cash flows. So when we talk about relevant cash flows, what we're talking about are incremental cash flows that are a direct result from spending by the company in an investment, or what we call a capital expenditure. Incremental cash flows are the additional cash flows, cash outflows or cash inflows expected to result from this particular capital expenditure. So say we were going to buy a new piece of equipment. So if we buy a new piece of equipment that's supposed to help us manufacture more efficiently or enable us to sell more units, those changes in our cash flow we want to look at. Okay. And we want to think about, it's very important that when we do capital budgeting that, there is some sort of accuracy, because estimates of cash flows from investment projects have a lot of forecasting, a lot of assumptions about them, and there could be errors. That's one of the real drawbacks of capital budgeting, is that you have to forecast future cash flows, and that's always tricky. And a lot of complications can arise based on unexpected events with the project, underestimating the costs, or underestimating the cost of disposing waste or disposing of the assets upon the end of the project. And managers, oftentimes when there's a merger and acquisition between two companies, they do not create as much value as they had forecasted. And if you do merge with a company or propose merger with a company, there is a lot of potential litigation that could be opened up, a lot of involvement with the government, with antitrust, and even possible loss of customers if you start buying businesses that your customers were also in business doing. They may not want to do business with you anymore. So there's been improvements in the valuation techniques to hopefully get a better, more accurate numbers to work with. So sometimes CEOs may try and justify the deal by monkeying around in the mechanics of the capital budgeting techniques. So that would be an unethical thing to do. So ethically responsible financial managers and CEOs and CFOs want to make sure that the analysis for taking on a new capital expenditure is accurate as possible. Okay. So let's talk about relevant cash flows, major cash flow components. One, we have the initial investment. So this is, say the cost of buying the new equipment or the cost of buying a new business. We have the operating cash inflows. So this is the incremental after-tax cash inflows resulting from the project. So, maybe you're investing to make a second location of your restaurant. So the money that second location generates as cash flow is one of the relevant cash flows. And then the termination cash flow. If it's a limited time project, maybe the lease on the second restaurant is only for 10 years, or the equipment you're buying is only in the last 10 years, you want to think about the termination costs and the termination cash flow in the last year of the project, when you have to liquidate the asset. Okay, so here's a graphical representative of cash flow components. So we could have, the initial investment, and then this initial investment can throw off different cash flows every year up to 10 years, and then the termination cost at the end of the year. So this would be sort of a graphical representation of the cash flow. Now, relevant cash flow expansion versus replacement decisions. So in finance, we usually talk about two big types of projects. Either the expansion, where we're expanding the company, or replacement decisions where we're replacing a current asset. So we might have some sort of manufacturing equipment that we're going to buy something better. So we want to develop the relevant cash flows as straightforward as possible in the case of an expansion decision. And in case of it, the initial investment, operating cash inflows and terminal cash flows are merely the after-tax cash inflows or outflows associated with just that capital proposed expenditure. So it's important that we keep it very clean. So we don't want to muddy up the analysis with any other costs not directly related to this capital expenditure or this decision. So we need to identify these relevant cash flows for replacement decisions. It can be more complicated because the firm must identify what's the incremental cash outflows and inflows that result from the replacement of the equipment. So that usually means forecasting and estimates, which can sometimes make the capital budgeting process less accurate. Here's a little bit easier way to think of it. So the three relevant cash flows. So we have the initial investment, and that's going to be the amount of money required to acquire the new asset. Could be a piece of machinery or a new company. And then we want to subtract from that the after-tax cash inflows from liquidating an old asset. So if we're replacing a machine, but we're going to be able to still be able to sell the older machine. Okay, operating cash flows. So operating cash flows from a new asset minus the operating cash flows from the old asset. So if you had purchased a new pizza oven that can make twice the amount of pizzas, that's going to be associated with more cash flow. But we still want to subtract out the original cash flow the old pizza oven was producing, so we could really see the net change. How much additional cash flow is it generating? And then the terminal cash flow. When we terminate the project, so we want to look at the cash flows from, terminating of the new asset, and also the termination of the old asset. So what we're basically saying is when we buy the new asset, we sell the old asset in the beginning, and then at the end, we're going to sell the new asset at the end of it. So really, from start to finish. So there are a couple concepts here that are important called sunk costs and opportunity costs. So sunk costs are cash outlays that you've already made that, maybe 10 years ago you bought a piece of land. So if you're going to do an analysis of building a house on that piece of land or building a business on that piece of land, you can't include the cost of that land because it was already purchased maybe for something else a long time ago. So it's a sunk cost. The cost is already there. This project, that cost has occurred whether or not you do this project. So we're going to call that a sunk cost, money that's already been spent, but it's not included in the project's incremental cash flows because you didn't buy that land specifically for this project. Now, opportunity costs are cash flows that can be realized from best alternative use of the owned asset. So the opportunity cost can be included as a cash outflow when you're determining the project's incremental cash flows. For example, opportunity cost is, if you make a decision to do one thing or the other, you're losing the opportunity to use that asset for something else or the cash for something else. So there is, in some cases, opportunity costs when you choose to do something with one capital expenditure. So let's talk about this example. So this company is considering renewing a piece of machinery it purchased 3 years ago for $237,000 by retrofitting it with the computerized control system from an obsolete piece of equipment it currently owns. So the obsolete equipment could be sold today for $42,000, but without the computerized control system. And it would be worth nothing, I guess they're saying. Okay, so the $237,000 cost of the drill press X12 is a sunk cost because it represents an earlier cash outlay. So what we're saying here, it's considering renewing its drill press, which it purchased 3 years ago. So 3 years ago, it made this purchase. That's a sunk cost. That's already done. So then you could sell it today. If you had that piece of equipment, it could be sold today for $42,000. Because it's obsolete, it's worth a lot less because it's older and obsolete. The proposed use of its computerized control system represents an opportunity cost of $42,000, the highest price at which it could be sold today. So if you keep if you don't sell the machinery and you keep it, you're losing that $42,000 that you could have sold it for. So that is what represents the opportunity cost. Because you're not going to get that $42,000 if you retrofit the equipment and keep it. You won't be able to sell it. So the $42,000 is your opportunity cost that you have lost. Okay. Relevant cash flows, international capital budgeting, and long-term investments. So international capital budgeting differs a little bit from domestic because cash outflows and inflows occur in a foreign currency. So if you have to move money from one currency to another, so you're taking dollars and buying euros with them to make the investment, there's a currency exchange risk that has to be considered in the capital budgeting process. And you could protect or hedge your currencies by using futures, forwards, or option contracts as a way of kind of locking in the price. And foreign investments entail a certain amount of political risk of how you're doing business in the other country. So if the other country changes their laws or changes the government or has any, this is type of risks that you could worry about by getting involved in foreign investments in other countries. So it's really, foreign direct investments, a transfer of capital management, capital managerial and technical assets to a foreign country. And it's a very popular thing to do because corporations are quite large and they're going to operate in multiple countries around the world. So, if you look at foreign direct investment in 2012, the United States was the largest recipient of $174 billion. However, that was decreased from $234 billion in 2011. And not surprisingly, China has a good deal of foreign direct investment themselves, and not too far behind the United States in attracting foreign direct investment. This means that foreign companies are willing to invest inside of China. So China and the United States are the two biggest destinations for foreign direct investment. All right, so let's look at the basic format for determining initial investment. So we look at the installed cost of the new asset. So the cost of the new asset plus any installation costs. And then number two, after-tax proceeds from the sale of the old asset. So depending on, are we going to make money or lose money in the sale of the old asset, and any change in working capital. So we would take the initial costs, we'd minus out whatever the proceeds are from the sale of the old asset, and then the change in working capital would be added or subtracted depending if that change is positive or negative. And we're going to talk about working capital in a minute. In a little while, we'll discuss working capital more fully. Okay, finding an initial investment, installed cost of a new asset. So the cost of a new asset is the net outflow necessary to acquire the new asset and the installation costs. So any costs that are necessary to put that asset into operation. The installed cost of the new asset is the cost of the new asset plus the installation costs, and it's equal to the asset's depreciation value at that time. All right. So finding the initial investment after tax proceeds from the sale of the old asset. So when we say after tax proceeds, we mean after we pay the tax. So if we sell the old asset and the difference between the sale price and the cost we paid for it, we may have to pay taxes on the profits, or we could get a tax deduction on the losses. So if the proceeds from the sale of the old asset, are the cash inflows. So if we sell it, that's cash coming in. So any net removal or cleanup costs resulting from the sale of the existing asset. Whatever we pay to clean up or to deliver or move the asset, we have to deduct from the cash inflow. Now the tax on the sale of the old asset. So the tax depends on the relationship between the old asset sale price and book value. And of course the government tax rules. So if you sell the asset for more money than its current book value, you have to pay tax on that. So book value is just a measure. It's calculated by subtracting the depreciation from the total cost of purchase and installation of the asset. So basically, if you depreciate an asset down to zero and then you sell it for $10,000, you're saying by depreciating it to zero, you're saying that there's no book value, and by selling it by $10,000, you have to pay tax on the full $10,000. So here's another example. Hudson Industries is a small electronic company. 2 years ago, acquired a machine tool with an installation cost of $100,000. Now, under the modified accelerated cost recovery schedule, a 5-year period, 20% and 32% of the installation cost will be depreciated in years 1 and 2. So in other words, 52% of that $100,000 cost, or $52,000, would represent the amount of depreciation at the end of year 2. So the book value would be the $100,000 you paid minus the depreciation that you took and got a tax credit for already. So that means the book value is $48,000. So that's how we would calculate book value. We'd look at whatever we'd add up whatever depreciation you've taken and subtract it from the cost, the initial cost of the asset to get our book value. Okay. So this makes it a little bigger so you can see it. So gain on the sale, form of taxable income. So gain on the sale of an asset. So support the portion, it's a piece bigger than the book value. So whatever you sold it, the money that's above the book value is going to be taxed at ordinary income. So assume around 40% for a corporation. So if you lose money on the sale of the asset, so you're selling the asset for less than the book value, then you have a tax savings or tax deduction. You can deduct it from your ordinary income. Okay, so that's basically what that is saying. All right, so finding initial investment after tax proceeds from the sale of an old asset. So if we sell the old asset at $110,000, then we're going to have a gain of $62,000. So it's the $110,000 minus the 48 gives us a gain, because 48,000 is what the book value is. So that's what we calculated. Remember back here, calculated book value of 48,000. So if we sell it for $110,000, that's a gain of $62,000. So the gain is made up of two parts: recaptured depreciation, the portion of the asset sale price is above the book value and below its initial purchase price. So the capital gain is actually $10,000. So you see, if you look back here, we purchased this asset for $100,000. The cost was $100,000. We're selling it for $110,000. Therefore, the capital gain is $10,000. Sale price minus initial purchase price. Okay, so recapturing depreciation is $52,000. The $100,000 initial purchase minus the book value. So this is recaptured depreciation. So the total gain above book value is $62,000 and is taxed at ordinary income. So the tax at 40% would be $24,000. So if the asset is sold at $48,000, its book value, it's a break even. You're selling the asset at the exact book value. There's no tax consequences. Okay. So let's think about, what if they sold it for $30,000? So it has a loss of $18,000. So it's a $48,000 book value, and we sold it for $30,000. So now we have a loss. So we would get a tax credit or tax savings of off our regular income of $7,200. So basically, we sold it for less than the book value. We're going to get we can basically think of it as a tax credit. And you may be able to apply these losses to future years if you don't have enough income in the current year to offset it. Okay, so this is just a chart looking at, if the book value is $48,000. So if you sell it at $48,000, there's no gain or loss. If you sell the asset at $30,000, there's an $18,000 loss, the difference between the book value to the sale price. If you sell it at $110,000, this is the capital gains is going to be from $100,000 to $110,000, and the recaptured depreciation is going to be the difference from the $100,000 to the $48,000, or the $62,000. If you sold it for $70,000, there'd be no capital gains, and the recaptured depreciation would be $22,000. So those are just different scenarios to look at. This 4 different sales prices of the asset. Okay, so finding the initial investment change in net working capital. So you told you we're going to talk about net working capital again. So net working capital is the amount by which a firm's current assets exceed its current liabilities. So if you take current assets, subtract current liabilities, that's your working capital. So there could be a change in working capital. That is the difference between the change in current assets and the change in current liabilities. So think of it this way. You are going to expand into a second location, and that second location is going to need cash to be put in a cash register and cash to be put into the safe to make change and for petty cash. So that's working capital. So that would be the increase of working capital. So I'm opening up a new store. I'm going to need to get $2,000 worth of cash for operating the store's cash register and backup cash in the safe. So that would be a change in working cash. So since I'm getting a second store, I'm going to need to get more assets of cash for that second store. I'm going to also need to get more inventory. So these are things, but there may also be some liabilities associated. I might have to be able to borrow some money for some of the costs of the new store. And that's really looking at the assets I'm bringing in versus the liabilities, and that's a change in working capital. So that has to be an additional cost of the investment, additional cash flow. So if you look at it, Danson Companies, the metal products manufacturer, is thinking about expanding its operations. So here's a summary. Additional cash for the new operation, additional money for accounts receivable, and inventory. So it's a total current assets of $22,000. They will get a credit for accounts payable, and they'll be able to accrue some of their expenses. So liabilities will be $9,000. The change in working capital is $13,000. Okay. Let's look at this example. Powell Corporation is trying to determine the initial investment required to replace an old machine with a new machine, a more sophisticated model. The proposed machine's purchase price is $380,000, with an additional $20,000 will be necessary to install it. So that means that the initial cost is going to be $400,000, the $380,000 plus the $20,000. It's going to depreciate in a 5-year schedule period. The old machine was purchased 3 years ago at a cost of $240,000 and is being depreciated under the 5-year rule. And the firm has found a buyer willing to pay $280,000. So the present machine, for the present machine, and to remove it at the buyer's expense, the firm expects that a $35,000 increase in current assets and an $18,000 increase in current liabilities will accompany the replacement. And the firm's going to pay tax at the 40% rate. So let's put this into a little bit more organized form. So cost of new machine, installation costs, total and installed cost $400,000. Selling the old machine at $280,000, minus the tax on the sale of the present machine, meaning that we're going to, since we're selling the present machine at a profit above, at a capital gains and above book value, there's going to be tax, and we're going to calculate that tax to be $84,000. So the proceeds after tax are $195,000, and then the change in working capital we calculated to be $17,000. So if we take the $400,000 and we subtract the $195 from it, and then we add the change in working capital, the additional $7,000. See this little minus this for $195,000. Add change in working capital, and that's how we get to the initial investment of $221,000. So we have to measure the benefits from the capital expenditures on an after-tax basis, because the firm will not have any benefits until it satisfies the government claim. So you have to always look at these after tax. So when we do a cash flow basis, we use cash flow because it's a better representation of the money being generated, and not accounting profits, because accounting profits have other elements in them that don't make them accurate for trying to assess valuation. So the basic calculation for converting after-tax net profits into operating cash flows required adding back depreciation and any other non-cash charges such as amortization or depletion, deducted as expenses in the firm's income statement back to its net profits after taxes. So we're just adding back these non-cash charges to show what a true cash flow is. Okay, so the final step in estimating the operating cash inflows for a proposed replacement project is to calculate the incremental relevant cash flows. So incremental operating cash flows are needed because our concern is only with the change in operating cash flows that result from the proposed project. For example, we want to look at the new money that the new equipment is bringing in, but we have to subtract what the old equipment was bringing in as well. So if we had an old pizza machine bringing in cash flow of $10,000 a month, and the new pizza making machine is going to bring in cash flow of $20,000 a month, the incremental cash flow is only $10,000. It's the $20,000 minus the old $10,000. So we're only looking at the additional cash flows we're getting above and beyond the old equipment. So in this case, you would look at with the proposed machine, we'd look at the revenue and then the expenses. And then with the present machine, we look at the revenue and the expenses for each of the years. So this is the revenue, these are our expenses, and here is for the other machine the revenue and the expenses. Okay. So we're going to get back to this in a minute. Here we have the depreciation schedule for the cost of the new machine at the modified schedule for a 5 period, and calculating the depreciation, how it's fully depreciated. And then we could see that with the present machine, here is the depreciation on the cycle in year 4, 5, and 6. So the total, we have only had it for 3 years, so we'll only depreciate $69,000 of it. So we take the revenue, the expense minus the expenses, and we get our earnings before depreciation, tax, interest, and taxes. We minus out depreciation to get our EBIT, and then we minus our taxes to get our net operating profit after tax. And then we add back our depreciation, and this gives us our operating cash flows, or OCF. All right, so in this calculation, let me make this a little bit bigger. Maybe one more. Okay, so in this calculation, we have our revenue for each of the years, 1, 2, 3, 4, 5. We have our expenses. We have our earnings before, this equals our earnings before interest and taxes, basically the 2520 minus the 23 gives us a 2020 for each of the years. We minus our depreciation, and remember the depreciation schedule back here. This is where we're getting that from. This is for the new asset. Okay, so those depreciations were filed in here, and then we took our earnings, subtracted out depreciation, and then our earnings before interest and tax. We want to take out our taxes on these earnings, so we get a net operating profits after tax, and then we add back depreciation to get our operating cash flows. What you won't see in here is the interest expense. So we don't factor in the expense of interest in these capital budgeting techniques because we do that later when we discount the cash flows. So here's our operating cash flows for the proposed machine, the new machine. Okay. Now with the present machine, these would be the cash flows of the present machine. So the revenues were lower, and the expenses were started out lower but got a little bit bigger. And then we have our earnings before. Then we had our 3 years of depreciation. And then we could calculate our tax, get our net operating profit after tax, add back our depreciation, and look at our operating cash outflows. And then we're going to take that. So remember here we have our operating cash flows in the proposed machine, 164, 183, 162, 151. And then we have the operating cash flows for the old machine, 137, 125, 106, 90, 78. So then to get the incremental, here is our new cash flows for the new machine, what our old cash flows for the old machine is, and then the incremental is really the change. This is how much better we're going to do if we get the new machine. And that's why we only want to really analyze the incremental cash flows of this example. Okay, so adding the terminal cash flow, or finding the terminal cash flow. What we're doing here is the terminal cash flow is a cash flow resulting from the termination or liquidation of a project at the end of its economic life. So if think of a car. So that represents the after-tax cash flow, cash inflows from the final year of the project, and you sell an asset. So it's the proceeds from the sale of an old asset. It's sometimes called the salvage value. It represents the amount of money net above removal and cleanup costs expected at the end of the project. So basically, if we have a piece of equipment that we're going to sell, we're going to get some money from that, and we want to include that in this project. But it's important to see if the proceeds if they exceed book value, then we're going to have to pay taxes on them. If they're less than book value, we may actually get a tax credit. So when we're calculating the terminal cash flows, the change in working capital represents a reversal of the initial net working capital. Say we had that store and we're closing the store down. We're not just going to close the store down and leave all the inventory there and leave all the cash in the safe and the cash register. No, we're going to reclaim that working capital. Take the money out of the safe, take the money out of the cash register, take the inventory bank back, and that's the return of the working capital. So we'll see a cash inflow from this reduction of net working capital as we reclaim it from the project. So what we're going to see here is the after-tax proceeds from the sale of a new asset. So we're going to sell the new asset, and we're going to either get plus or minus on the tax, and then we have the after-tax proceeds from the sale of the old asset, and plus or minus a change in the working capital, and that's our terminal cash flow. All right. So here's an example. We go back to that Powell Corporation expects to be able to liquidate the new machine at the end of its 5-year usable life to net $50,000 after paying for removal and cleanup. The old machine can be liquidated at the end of year 5, at the end of 5 years, to net $10,000. So the firm is also expecting to recover $17,000 net working capital upon the termination of the project. And of course, we pay a 40% tax rate. So what this would look like is here's the proceeds from the sale of the proposed machine, and minus the tax. So we obviously made a profit, so we're going to take out the tax. So here is our after-tax proceeds from the proposed sale of the proposed machine. And then we want to subtract the after-tax proceeds from the sale of the present machine. So we sell the present machine for $10,000 minus the taxes we pay on that, so then we make $6,000 in the sale of the old machine. So we're selling both the new machine and the old machine was sold earlier. And then here's the change in working capital. We're going to get that $17,000 back. So we're going to get $38,000 from the sale of the proposed new machine, $6,000 we got from the sale of the old machine, and $17,000 from the return of working capital. So the terminating cash flow is $49,000. All right, so let's summarize. Initial relevant cash flows. Initial investment, that's the operating cash, the initial investment. And then we have the operating cash inflows, and then we have the terminal cash flow. Together represents all the relevant cash flows of the project. And these cash flows can be viewed as incremental cash flows, attributing to the proposed project, meaning the money above and beyond what we would have done if we didn't take on the project. And they represent a cash flow sense of how much better or worse the firm will be by implementing this new project. So the incremental cash flows are basically just saying, are we better off with this new business, store, or asset? And we can only tell that by looking at the incremental cash flows. So here, if we have a timeline, here's the initial investment, the incremental cash flows, and then the terminating cash flow. So we have the operating cash flow for year 5 plus the terminating cash flow gives us the total cash flow for year 5. And then what we could also do on this is we could discount. We could use net present value actually to figure out the net present value of this project to put it in total dollar terms to see if it was worth it. Okay, so the review of the learning goals today, we discussed the major cash flow components, incremental, operating, and terminal. And we discussed the relevant cash flows, expansion versus replacement assets, sunk costs, opportunity costs in international capital budgeting. And we talked about calculating the initial investment associated with the proposed capital expenditure. And we talked about the tax implications associated with selling an asset above, at, or below book value. And we found the relevant operating cash inflows associated with proposed capital expenditure. And lastly, we determined the terminal cash flow associated with a proposed capital expenditure. Okay, so that is it for Chapter 11. Thank you for your time.